Hi, this is Jim Cunningham. Welcome to Income Tax Strategies for Business Owners. I am joined today by Phil Wilson, my good friend and a great accountant at Markham, which is one of the top national firms, national accounting firms. Phil, it's nice to have you with us. And you're joining us, I think, from your Costa Mesa office today. Is that where you're at?
Yes, Jim, thanks for having me today. Yes, I'm in our Costa Mesa office.
Great. So this is a quick disclaimer. I'm a lawyer. I'm talking. This is not legal advice. Phil's talking. This is not accountancy advice. You are not necessarily clients by watching this video. Okay. You're not clients by watching this video. And just take this as such as information. We're going to go through rapid fire as we do on these videos. We're going to go through rapid fire on a lot of content. So just kind of hold on to your hat. Subscribe to our YouTube page. It's a great way to stay up to date. It will pop up in your YouTube feed. And you can see our latest, and these are released weekly. So Phil, I've known Phil for several years. Phil is a very experienced CPA, over 30 years experience. He was an IRS revenue agent, also known as a revenuer, and he is the managing partner of Markham's Costa Mesa office, and he's head of the National Tax Controversy Group. So what that means is if the IRS comes, asking for money and they start suing you, their firm is involved in matters like that. And he helps resolve tax controversies with the IRS and represents businesses and high net worth individuals. I am Jim Cunningham, 25 years plus experience. We have offices in California. I'm a certified specialist in estate planning, trust, and probate law. I'm also a real estate broker, insurance, and securities license. So Phil, you and I are here today because we have a lot of mutual clients. Most people want to pay the least taxes,
yeah.
Right? Most people want to pay the least taxes possible while securing a legacy for themselves, their family, and their loved ones. And Phil and I are here today to help you kind of walk through some strategies to think about. And, ultimately our job as professionals is to counsel you, give you options, make recommendations that reduce your overall tax bill, leading to more wealth for yourself, your family, and your loved ones. And, getting ready for this, Phil, Tom Wainwright is a CPA, and he has a fairly big YouTube presence. And I was a guest on one of his shows, and he has this really interesting way of looking at things. And when we were getting ready for this, Phil, you looked at this, you're like, wait a minute, this can't be right. What we are talking about is like the total tax that you pay. If you go to school and get a job, you're basically paying 40% tax. If you go to more school and become a specialist, maybe you're an engineer, maybe you're a lawyer, a doctor, or an entrepreneur, by the time you add up all the taxes that you pay, I'm talking like all the extra payroll taxes and all these other taxes, you're now at about 60%. Why would anyone go from 40 to 60% tax bracket? Different question, Phil. But if you are a big entrepreneur, a big company, what we see is those companies tend to pay less tax overall. And it's because they're employing many of the strategies that we're going to talk about in just a couple of minutes. And if you're an investor, Phil, I don't think you can get to zero, but you
right.
and I talked about
but it is a lower amount.
It's
right.
a much
lower
lower
debate
amount
out there.
Yeah.
Right.
And when they say rich
because
people don't pay, when they say rich people don't pay a whole lot of tax, it's true.
Right. I mean, you look at Warren Buffett. I mean, a lot of his money is invested, and he may pay capital gains. But he may not be paying payroll taxes, et cetera. So, and then a lot of the billionaires, the ultra wealthy, they can borrow on their accounts, and the debt that's not taxable. So the Wall Street Journal had an interesting article about that about a month or two ago, and was talking about how the ultra rich don't get taxed on the value of their assets.
Right. Yeah, and if you're a billionaire and you want to buy a jet or another house, if you're Jeff Bezos, you just go to a bank and say, I'm going to borrow, $100 million off my Amazon stock. What's the bank going to say? Sure.
Here you go.
Here you go.
Right.
You're not paying tax on that. You're not selling the stock. Yeah.
Right.
So let's talk about
Jim, that brings us.
Yeah. Let's talk about the importance of tax planning, Phil. And I will tell you that what Phil and I see quite frequently are people who are business owners, and the clients tend to outgrow their advisors because their business starts making a lot of money. And the tax advisor says, okay, bring in all your receipts in, February, and we'll run the tally and we'll tell you what the tax bill is. Unfortunately, it's too late to do a lot of these tax planning strategies that we're going to talk about. But you see your really successful clients, Phil, they're engaging in multi-year planning, aren't they?
Well, they are. And the reason why they want to do planning is for two reasons. One, they like saving tax, But another even more important reason is they don't like surprises. They like to know what's coming. And if they're going to have a large tax bill due, they want to know because they have to manage their cash flows just like everyone else. Every business has to manage its own cash flows.
So what is a business? And I'll tell you, we have a lot of lawyers actually on this webinar. And this is really important. So whether this is you or maybe your clients, what is a business? Okay. If a business is not passive activity, you can't hand your, your stock portfolio to a financial advisor. That's not a business, right? They're doing the heavy lifting, but it's effort and most importantly, activity. Okay. You have to be, time has to be engaged in this endeavor. And it comes in various forms, S Corp, C Corp. We'll talk a little bit about that. And our focus today is on for-profit entities because nonprofit entities, of course, Phil, don't pay tax. So if you're actively trading stocks, if you were trading GameStop, for example, right? And some people made a lot of money on GameStop. Those people were working all day, right, Phil? I mean, they were working this thing, the market's open, they're there working, researching. That would be considered an active trader business. But if you were to hand that money over to a financial advisor, it doesn't. And there, as we kind of get into, and I'm teeing this up so you if you're watching this, you understand. There really is a division. The tax code treats business owners completely different from W-2 people. And I like to put these into two camps, the owners and the loaners. You own your labor. We're born on this earth and we leave this earth. And during our time on earth, we have our ability to work. We can choose to use that on our own efforts, our own labor in pursuit of profit, running a business, or we can lend our labor out to an employer. And the benefit of lending your labor out to an employer is it makes it so you get a minimum wage, right? Or a minimum amount or a salary, but it does compromise your top end. The government, frankly, rewards business owners more than it does W-2 people. Okay, that's fundamentally what's going on. And there are far more, Phil, tax planning options available to business owners than individuals, aren't there?
Well, that's true. Yeah, having your own business is, while it's not a tax shelter, there's definitely a lot of things that can be done with planning and a lot of deductions. Employee business expenses used to be deductible and now they're not. But if you have your own business and you deduct your expenses, that's allowable.
So we're going to talk about, I'm going to go through tax basics. And one of the things that I like to do is we like to tackle complex topics in a way that normal people can understand. Okay. And when we talk about taxes, I think a lot of people freeze up and their brains stop working and they go, I don't understand any of this. Okay. But there are three major categories of tax benefit that we're going to talk about: a tax credit, deduction, and deferral. A tax credit, why don't you talk about what a tax credit is? It's like cash, isn't it, Phil?
It's just like writing a check to the IRS, getting a credit, and there's many different credits available. We'll get into that. But it's just like writing a check to the IRS. If I get a tax credit for $100, it's just like I paid $100 of tax. And
a deduction subtracts the amount of your taxable income, so it's not as good. And a deferral is a deduction, but you have to pay it later. So I'll give you some examples here. So a tax credit, you obviously deduct that from your tax bill. So let's look at Olivia. Olivia makes $1 million a year. Her federal income tax is $329,000 and change. If Olivia receives a $100,000 tax credit, it means her tax bill drops from $329,000 to $229,000. That's what that means, a tax credit. It's like the government is giving you a coupon to pay your taxes with. A tax deduction reduces Olivia's $1 million income down to $900,000. And so it reduces her tax bill from $329,000 to $292,000. So it's a benefit, but as you can see, it's not nearly as good as a credit. I would say Phil, credits are like solid gold, right? That's like the gold standard. That's what if you could pick a credit, a deduction, or a deferral, I'm taking the credit, right?
Right.
And a tax deferral subtracts that income, that $100,000 tax deferral subtracted from Olivia's $1 million income. So now she has $900,000, but at some point in the future, that money comes back in potentially, right? Comes back into her as,
right.
as taxable income.
As income.
You can think of it as an interest-free loan. Okay, so tax deferrals are valuable in the sense it's an interest-free loan. And we have a question here. Charles says, my startup company just got bought out and I'm expecting a large cash settlement as well as some extra shares of the new company. What are some strategies for deferring or lowering taxes? Charles, I know you're a client and that's something we can certainly talk about one-on-one. Some of these strategies will apply to you, some won't. So let's talk about what we call basic tax hygiene, Phil. Do people always pay their estimated taxes?
Well, they don't. And yesterday was a due date for individuals for the third quarter estimates. So no, unfortunately, they don't always pay them. They either don't plan, they decide they want to use the cash in the business or other things. But the penalties that they have to pay are non-deductible. So there are penalties and interest, but a lot of people do end up paying those, but they're avoidable with planning.
Yeah, and I'll say, I'm a business owner. As a business owner, sometimes I get really busy, right? So if you're a busy person and you got a lot going on, one of the last things you ever want to think about is paying taxes. But this is something you really should be doing. And it's very important. State laws can and do differ from the federal laws. So what you pay, there's not necessarily a correlation between state and federal, and you can get tripped up. And California's penalties, by the way, are pretty severe, aren't they, Phil?
They are.
Yeah. Another question, Don asks, what if homeowners don't owe taxes? Do they lose the tax credit? It's only for 1 year tax credit. I'm not sure, Don. I'm not sure. I think that might be the property tax issue. Listed transactions. What is a listed transaction, Phil?
That's one that the IRS has designated as abusive, and we like to stay away from those.
Okay.
It does mean that you actually have to disclose it on the tax return when you file. If you don't, there's really onerous penalties.
There's a dirty dozen list. When I was doing research for this, I could only find 11 because they don't really put up a list of 12. I had to cobble it, and I could only come up with 11.
Right.
So, again,
and what these really are, is the IRS is really focusing on these and has its agents looking into these. So, for example, if you take number 5, syndicated conservation easements, that's where they, donating land to charity. If I want to just donate land I own to the Sierra Club, that's a conservation easement, that's fine. That's what it's intended for. It's when you syndicate them and you mark up the value and you have a false valuation in there. And a lot of people got caught up in that and they're doing that. That's a listed transaction that you have to disclose on the return. And the IRS is really coming down hard on the promoters, the people who do the valuations, the real estate values, and taxpayers.
Yeah, but that's different if you have like a 2,000 acre cattle ranch and you want to dedicate it to open space and essentially donate your development rights. Totally different thing.
That's fine. Right. But see, what they're saying is syndicated conservation easements.
Right.
So yes. Yeah.
So the hierarchy of tax strategies, tax credits are best, tax deductions are better, tax deferrals are good, but really the best is a credit. Here's the problem, folks. Tax credits are the least discussed. Okay. Tax deductions, you talk about those a lot. Tax deferrals, that's really heavily discussed, and we'll talk about that as well. But I would say the tax credits are probably the least understood, least discussed. So let's get into it. This is why you're watching this. Let's get to the tax credits. Some investments or other ways of deploying capital, which may not be the greatest investments, okay, just truth be told, some investments can get you a tax credit. Okay, so what this means is you are placing your money in an investment, in an activity, in a location. And by the act of placing that investment, the government gives you a tax credit, and you're able to use that to pay, essentially to pay your taxes. Now, these are a laundry list of all of the tax credits that are out there. And we're going to cover just a few. And we're going to start with the federal opportunity zone. So you want to talk about the federal opportunity zone?
Right. So the opportunity zone is for companies that are in a designated zone, designated by the federal government. And if the company is in the zone and its employees are in the zone, or any employee, then they do qualify for these credits. So there's maps available if your company is in the zone. then what we do is we take a look at the payroll and we see which employees actually live in the zone and they qualify for credits. And the reason for that is much like a lot of tax policy is they're trying to dictate behavior. And so there's areas that are not as desirable to be in. For example, here in Orange County, you could put your company in Irvine or Newport Beach, or you could put your company in Santa Ana. If you're in Santa Ana, you're in the empowerment zone, and you can get some credits for that. And there's state credits also in California.
Yeah, and a lot of people live in Santa Ana, and a lot of businesses are located in Santa Ana. So this is something that, if you don't know, your business may be located there. You may have employees who live there, and you may be losing out on an opportunity here. So what this is federal opportunity zone. If a business has a capital gain, they have 180 days to move the money or deploy the money into an opportunity zone. It defers your taxes, and it also eliminates some tax. So we put this in the category of tax credit because it's essentially a tax-free, a portion of this is
and some deferral as well, right?
So that's the federal opportunity zone. That is one method, okay? But this has to be with an entity, right? You've got to be. This is not you're just a sole proprietor putting on a Schedule C on your 1040. You have to be an entity, and a single member LLC will not qualify. And so this is something that Markham helps their clients out with quite a lot. Now, the federal empowerment zone tax credit. What's going on here? What's the government doing?
Well, again, they're looking at where the location is, and that's where, if the employee is in the zone, they get credits. And so that's something that is very important to our clients who live there. And what's interesting is, a lot of times you as the business may be approached by the city and say, you know what, you're actually in an empowerment zone. And a lot of times, I'm here from the government and I'm here to help. A lot of times they ignore it, they don't believe it. And it's very interesting because I've asked people who become clients, I said, well, aren't you actually in an empowerment zone? And they said, well, I think so. I've heard, people have tried to talk to me about it, but unless it's from a trusted advisor, they really don't believe it. So it exists, but a lot of people don't take advantage. And
I would chalk this up. A lot of these are things that you should be doing as a business owner, quite frankly, that many business owners don't do. And, if there's a $20 bill laying on the street, bend over and pick it up if you want a $20 bill. I mean, it's there. A lot of this stuff is figuratively speaking, you've got to claim it, for lack of a better term. So what this is if you employ people, you can get a tax credit of up to $3,000 per employee if the employer and the employee reside within the empowerment zone. And these are some empowerment zones. So if you got, this looks like kind of South LA, sort of Central LA, and then you also have the opportunity zones in Santa Ana.
And they're around the state also. I think there's some in Fresno and various parts. So they're here in California.
Yeah, and doing research, there's actually an interactive map, and there are a lot in Sacramento and Bay Area. So these are pretty common. So if you're thinking about, should you move your business? Are you going to move if you're a lawyer, a law firm, you're going to move your offices? You might want to look at some of these empowerment zones and employ people from here because essentially it's free money. So let's talk about commercial solar. So you might be seeing these. I was at IKEA in Sacramento a couple of weeks ago, and they're installing a massive solar array. So it's one of these things where you have the big solar panels on the parking lot. This is not putting solar on your house. This is not a small project. These are very large projects. And what happens is the government is encouraging American taxpayers to invest in solar projects so that we can get more of our energy from the sun. I mean, that makes sense, right? So that's what's going on here. This is not installing solar on your home. This is not installing solar on your business. That's a separate issue. But this is investing in a business that builds a solar project, owns and collects recurring payments from, not random people, but these are large companies. These are Fortune 500 companies. These are public utilities. These are
nonprofits.
Nonprofits. So you want to walk us through some of the benefits?
Sure. So the credit can vary, depending on when the panels are placed in service and when they were purchased. You're able to get a tax credit, which again, Jim was saying, tax credit, very valuable. But also the panels with the Tax Act from 4 years ago, Trump's Tax Act, the panels qualify as 5-year property, which means they're eligible for bonus depreciation. So what that means is normally you can write off 100% of that property. In this case, and Jim, I think if the credit's 26%, you have to reduce it by half the credit. Right. So we would have, if it's a 30%, there's a lot of panels that are 30%. And so you get a 30% credit, you would reduce it by half and by 15%, and you're able to write off as depreciation immediately for federal 85%. So you have your income, you have your business income, and there's a lot of nuances here. I mean, it's got to go against business income. Right. It can't go against W-2. It can't go against portfolio, which is interest, dividends, cap gain. And so you're able to get a deduction from your business income, and then you're able to get a tax credit. So it works well. Generally, it starts if you have around $3 to $5 million of business income, or if you have a liquidity event and you're selling your business. That's something that we definitely work with a lot of our clients. And Jim and I have worked on quite a few this year on clients that have needed that, and they're also in a business.
Yeah. So here's an example: a $2 million LADWP, that's Los Angeles Department of Water and Power, meaning LADWP is going to buy the power. For those of you who live in Los Angeles, you know that that's a really great creditor because you pay them money every month, right? And if you don't pay, what do? They shut everything off. So they're gonna be making money, LADWP. So what happens is this investor essentially buys a solar company, right? And puts $2 million in, gets a federal tax credit of $590, federal depreciation on the $2 million. That equals about $729,000. This is just federal, plus state of $256. So your total tax benefit is over $1.5 million. So what you do is you put $2 million in, and you pay $1.6 million less in tax. If that makes sense. So what you have left is about,
and you get cash flow.
Yeah, and plus you get cash flow. So you get your net out of pocket $400,000, right?
Right.
And you're going to get,
and the way these work,
yeah,
that's right. And so the way they work is the developer approaches a company or approaches a nonprofit and says, you know what, how would you like to cut your power bill? And it's, whatever the numbers are. And they say, that'd be great. What do I do? Well, you sign a 20 or 25-year power purchase agreement with us, and you purchase the power at a discounted rate. And then they go out, developer goes out and finds investor, sells them the project. They take the tax benefits, and they also take the income. And then there's, that's the net income, Jim, that cash flow of $62,000. That's after insurance, the management fees paid to the developer to manage the project, take care of it, make sure the insurance, all that sort of thing.
Yeah, and we can accurately predict how much power these the photovoltaic cells will generate because we've got 150 years of weather history, and we know when where the sun's going to be in the future, right?
Right, and they do they do use the weather data, and people ask, well, how long do these panels last? They're warranted for 30 years, but I mean, there's still satellites from the 60s that are powered by solar panels. Same technology. They do degrade a little bit each year, but they're still up in the sky and working.
Yeah, we do a lot of. Phil and I have worked on with clients on a lot of these structures. It works for some people. It doesn't work for others. It just depends, right? This is not for everyone. Right. Federal Work Opportunity Tax Credit. So you're an employer. The federal government wants you to hire certain types of people. Okay. So this is, and what this means is, within 28 days of hiring a new person, you got to fill out this paperwork. And this is something that Markham does. You guys do for your clients all the time, right? But basically
we do.
Yeah. If people are coming off of food stamps or SNAP, or they're discharged from the U.S. Armed Forces within the last year, or an unemployed veteran, that's been unemployed 6 months or more, long-term unemployed, or ex-felons, okay, you get a benefit of anywhere from $2,400 to $9,600. So you may be leaving money.
Right. Generally it's 2,400. Disabled veterans 9,600. And again, they're using public policy in the tax code to really direct behavior. And there's a lot of veterans that get discharged from the service, and they struggle. They need to get a job. So there are these centers out there where you can go and you can actually they'll help you. They'll place veterans in your company, and then you can get a benefit.
Yeah, my daughter served in the U.S. Army, and when she was discharged, it was interesting because you're used to being in the military, and then you're out in the civilian world, and you kind of have to relearn a lot of how to work in the world, quite frankly. But these are great.
Right.
If you've got a restaurant or hotel, auto dealerships, medical groups, manufacturers, security industry, retailers, construction, or if your payroll's 10 million or up, really pay attention to this, because you're just kind of leaving money on the table if you're not paying attention to it. So we have an example. ABC Corp has, this is kind of in the real world. ABC Corp has 150 employees. They have turnover, which actually isn't that, well, depending on your industry, this is good or bad. 40 employees a year, maybe 10 qualify. So that's 24,000 a year of a tax credit, right? So you don't pay tax on a tax credit, do you, Phil?
No, a credit is a credit. It's dollar for dollar. And the other thing is there's a form that we can provide. Our partner in charge of tax credits and incentives actually has something which you can put in your employment package. And it's a 2-page form. It asks the questions. And if any of those boxes are checked, then we can follow up and help with the credit.
But remember, it's within 28 days of hiring. That's important. Right. You got to be on that. So this is something you definitely want to communicate with your HR. R&D tax credits. Walk us through, what is an R&D tax credit? If somebody hires me to write software, can I get a credit for that? No, right? But just walk us through that.
Yeah, so everyone thinks that R&D is really people in white lab coats, and while that does qualify, and we have clients that do that in the medical device industry, et cetera, it can also just be a process or a procedure. It doesn't have to be that. It could be software implementation where you're actually doing things and changing it, making things more efficient. So there's a lot of different industries that really do get a good benefit of R&D, and one of them is construction. A lot of construction companies have to design every project. It's all custom, and so a lot of that qualifies as research and development.
So if you're in a construction firm, it might be good to take a look at this, because you might be leaving some money on the table.
Right.
All right, so let's move to tax.
Manufacturing. Jim, I would even say manufacturing and distribution. Even distribution companies, if you're buying and selling, if you're doing the product design, that qualifies. If you're doing product design and you're having it manufactured and then you purchase it, you're doing the R&D in-house.
Well, moving from tax credits, which is the best, to tax deductions, which is still good. Right? Still good, but not as great as a credit. Moving to a tax deduction. I have this conversation over and over again, and a lot of times it's with professionals. If you're a lawyer and you're not incorporated and you're, making a couple $100,000 a year, 400,000 a year, 500,000, you really should look at an S corp. So an S corporation is a corporation that is what is called pass-through, meaning all the income passes through to the shareholders. There is zero federal tax that is paid in an S corp. There is state tax paid in California for an S corp, a small amount, but it's usually associated with smaller businesses, and it gives you the regular benefits of having a corporation with the privileges of the tax exemption, like a partnership. So let's say Mac owns the shares of Mac Inc. that owns a franchise restaurant. Well, let's just say it's McDonald's. So Mac takes a salary of $1 million as president as a franchisee, as the president of this McDonald's. He takes dividends of $900,000. So what this does, Phil, maybe you can say, look, this is saving $31,000 in tax. Now, why is that the case? What's going on here?
So the company, before his salary, earns $1 million. And so what he's doing is he's taking a salary of $100,000. You need to take what's called a reasonable salary, and that just depends on your industry and everything else. And then what he's doing is he's taxed on the other $900,000. It flows through on a K-1, and it's taxed on his individual return. But because he's below the threshold for the there's unlimited Medicare tax, right? So he's not paying unlimited Medicare on the other $900,000, and he's saving some on the payroll taxes, which cap at a higher rate. He does save some employment taxes.
Russell asks, is there a threshold income amount where a sole proprietor should form a sub-S corporation?
It's really a facts and circumstance. Being a sole proprietor and filing on a Schedule C is much simpler. You don't have to recognize the corporate formalities. And Jim, I know your firm does a lot of that with the annual upkeep of minutes and all that sort of thing. It's really a facts and circumstance. But once you start making quite a bit of money, it does make sense to look at becoming an S corporation.
Yeah, I mean, I think my understanding is also if you have a corporation, your probability of getting audited is significantly lower, as opposed to
probably is rather than Schedule C.
The other thing is, I would say, to give you a number, I would say probably like 200,000. But it depends, probably 150, 200, because there's a care and feeding element of having a corporation. There's tax compliance. But I would say, that's probably starting to be break even a little bit. It also depends on your industry. It depends on if you're working. If you're not working and you own it, you may want to, you may not even want to take a salary, right? If you're actually not doing anything. Sika asks, can the company S Corp owners, so let's say it's an S Corp and the owners own the S Corp, can the owners also claim R&D tax credits on their payroll, or can it only be claimed on the employees hired by the S Corp?
No, it qualifies for the owner also. It's whoever's performing the R&D services. So a lot of times the owner, the shareholder is performing those services. They're involved in the R&D, and so yes, it does qualify.
Talk about qualified business income. Now, this, I would say the big exception, this does not apply to lawyers, accountants, or other engineers,
right.
But doesn't it apply to architects? I don't know, or people in the real estate industry.
They must have a better lobby than us, Jim, CPAs and attorneys. Right, but it's a deduction. So the reason why that was there, again, that was in the TCJA from 4 years ago, is because when they lowered the corporate tax rate on C corporations down to 21%, they said, okay, we need to do something for those that are in S corporations. So what it allows is that 20% deduction. And it's not just S corps, it's also partnerships. So it's for flow through entities, and they're allowed to take an extra deduction, just like you bought equipment or just like you paid rent or any other expense. It's a phantom deduction of 20%. And there's some limitations. You have to look at wages, and that's, if you're not paying wages, you don't get it. But it's there to create jobs. Even though, Jim, as you know, we're a large CPA firm with 2,500 people, and we create a lot of jobs, but we don't qualify because we're in the business of accountancy.
Right. And lawyers don't get this unless you're under 400. So let's look at Carl.
Right. Well, there is an income limitation. Good point.
So Carl, shocker, owns a Carl's Jr. restaurant. So Carl's business income from the S Corp is $1 million. What's he able to do? He's able to deduct 20%, 200,000, saves him 74,000 in tax.
Right. That's his net income.
That's what's going on here, folks. It's not rocket science. I would say most CPAs, most tax professionals, do they know this or not, Phil? This has been around for
yes, they do. Yeah. Most do, but I just ran into one yesterday with a prospect, and his accountant had missed it. So we're going back and amending 3 years.
Phil, you and I have worked on so many cases together. Sometimes accountants mess up. And I'm not talking about you, but I'm talking about other people. And it can cost people. Well, in one case, it was $2 million for one of our clients because they didn't check a box on a partnership tax return. Really pay attention to this. This is something you spend the vast majority of your waking hours on your business, working on it, making it a success. Don't ignore taxes, right? Because that federal government, the state government, it's almost like they're shareholders in your business. Let's talk about cost segregation. So typically, if I buy a commercial property, I'm going to depreciate that over 39 years, right? 39 and a half years, whatever it is. 39 years, 27 right. for residential. But let's say I buy a commercial property and I don't want to wait 40 years to depreciate the property. I want to save some taxes now. I want to accelerate those deductions. Walk us through cost segregation.
So again, Jim, you're right. You buy a commercial property, and it could even be, like you say, multifamily apartments. They're depreciated a little faster, 27 years. But essentially what you're doing is there's an engineering study that goes in and looks at the personal property and breaks out all the different components, as you can see here, some lighting, windows, et cetera. And so those get depreciated at a faster rate. And again, we can take bonus depreciation on that and accelerate that immediately. So we can also do a catch up. If it's been in service for a few years, say 3 or 4 years, we can do the catch up also and take that deduction in the year we do the study. So for right now, we're sitting in 2021. We can do a study. We can do the study as long as we do it before you file your 2021 tax return. We could do that. And a lot of people have income that flows through from their real estate. So even after their normal depreciation, not only are they getting good cash flow, but they have taxable income coming from that. And so it can offset, that depreciation can go against your other real estate income as well. So it's a very good thing that's in the code that's allowed.
A very recent development, and this, if you're a business owner, this is going to be probably one of the most productive hours you could have all year watching this. California has just enacted an opportunity to work around on the SALT limitation. So what this means is right now you can only deduct up to $10,000 of your state and local taxes as an individual. So if you flow through, so if you have an S corp or a partnership and that income flows through to you on the individual level, and then you pay your state income tax, anything above 10,000, you're not getting a deduction on. Okay. So what has California done, Phil?
So California said we'll allow a workaround, but it's only at 9.3%. So 9.3 is the tax rate that you pay. It can't be any less. It can't be any more. The highest marginal rate over $1 million goes up to 13.3%. This is only 9.3%. If your tax rate is less than 9.3%, you can still do this, but you're paying 9.3%, even though your rate may be lower. So it's complicated. Guidance is still coming out. A lot of the states are doing this. They all have different due dates for when it needs to be paid. So it's very complicated and it's evolving. But it is nice to see that there is a workaround for that. It would be nicer if the federal government would just reinstate that in the Tax Act. If they're taking some things away, why not reinstate this? But it's not currently in the proposed bill.
Let me ask you, Phil, if every state does a workaround, do you think the federal government will just reinstate the deductibility because they're not getting the money anyway? I mean,
I don't know. I mean, Jim, when it comes to taxes, nothing's logical. Nothing really makes sense. So it's hard to tell what Congress is going to do.
True. All right, let's talk about tax deferral. So the most talked about, we're going to go through kind of quickly a fair amount of tax deferral strategies. So what we have here is the cash balance pension plan. And so what this is you can put, your 6,500, whatever it is now in your 401k or your IRA, your Roth IRA. You can put money into your 401k. But if you're a business owner and you're like, you know what, I'm making $1 million a year. How can I really move the needle and pay and defer a lot of my income tax? You can set up what's called the cash balance pension plan. And what this is this is funding a defined benefit plan. And so what it is it's like the old fashioned, when my grandfather, this is a true story, when he retired from General Motors in 1973, he got a pension, he got a check. He was a tool and die maker in Detroit. And when he retired, he got money every month. That is a defined benefit plan. You hit this age, and this is your age and years in service and the amount you make. It's a lot like a PERS pension, right? It's where this defined benefit that comes to you. Defined contribution is a 401k plan. So these are two different types of plans. And what happens is you're able to put away a lot more money is the bottom line. Contributions can be as high as $336,000 per year. And this is per person, and they're tax deductible. Okay. So this is a tax deferral strategy, right? And this is something you would want to meet with a qualified financial advisor to do. But Phil, I see these quite often with many of our clients. They do have a cash balance pension plan because, if you're making $1 million a year and you're not spending it, it makes sense to be putting this money away, at least defer it, right?
Right. You're going to be taxed on it when you take it out, but obviously it's very good to reduce current tax.
Sure. So Sam's a plastic surgeon with no employees. At his age, he can deduct $336,000 and put that in his cash balance pension plan. He pays $124,000 less in tax. Tax deferral strategy. That's a lot of money. Paying $124,000 less in tax. Okay.
Right.
And I'm gonna discuss here. We've done charitable trust webinars in the past, but there is a method, and this is almost like a 1031 alternative. You can think of it as a 1031 alternative. You can use a charitable trust to defer taxes. So what is a charitable trust? What I'm talking about is a charitable trust is a tax-exempt, irrevocable trust that's designed to reduce the taxable income of you, an individual, by dividing the benefits of ownership between an individual and a charity. So if you can think of a pie, right? So think of a big apple pie. A charity has to get a 10% slice. So it's just about the distance between noon and 1 on a clock, right? Maybe 1:15. The charity has to get a kind of a skinny slice. But what this does is you can essentially attach a tax deferral strategy to a charitable chassis. So Olivia's 50 and she wants to sell a duplex that will result in $1 million capital gain. She doesn't need the money. And this is actually very common for clients. They're like, you know what? I want to sell this investment. I don't necessarily need this money to live on, and I really don't want to pay the tax. She wants to avoid the $371,000 in taxes because that's the rate when you combine at least the current federal capital gains tax rate of 20 with California state 13.3 plus 3.8% net investment income tax. Poof, you get 37.1. That is $371,000 in capital gains tax. So she contributes the duplex to a zeroed out charitable remainder unit trust. I know it's a lot to throw at you, but I'm just going to go over this concept with you. And it has an annuitized 20.69573 payout, which as of this month is the correct payout for a zeroed out. That number changes every month, by the way. She gets, not only does she get a $100,000 deduction, so she's going to pay $50,000 less in tax, but she gets the payments over 10 years. So what we're talking about here is somebody who wants to sell a duplex, does not want to do a 1031, and wants to benefit from the lower tax brackets, right? Instead of taking all that income in 1 year, is benefiting from the lower tax brackets. So she's getting a payout over 10 years, and the total she's getting is 1.1 million. And the charity at the very end actually gets 216,000, the way the math works out. And that is an example. Conceptually, if you say, I don't want to do a 1031, what are my alternatives? This is something you can consider. And this is something our firm, working with Phil's firm, because you got to keep track of the numbers on this, right? So this would be our firm and Phil's firm working together.
And Jim, I just want to add, also, we've had clients do that. And then they say, well, but I want to leave something for my children. What do we do? And you can replace that with life insurance. So there's a way to do the tax. We couple it with the life insurance. It's a great plan. And that way the children do get what you intend to give them.
Yeah, we've got a great webinar on our YouTube page on charitable planning and charitable structures. And I would encourage you to take a look at that. But, I'll tell you folks, this is not easy stuff. This is hard stuff. And I will tell you, something I've noticed as I have been practicing law for 27 years now, there is a great variety of, I don't want to say competence and experience, because I'm not implying that people are not competent. It's just that you only know what you know, okay? And a lot of people focus on this and many people don't. And this kind of goes back to the point I made at the beginning, which is sometimes people outgrow their advisors. And I'm not, suggesting that you have outgrown your advisor. I'm just saying we meet with people who say, my own advisor, my own CPA has told me they need a new CPA because they don't have the toolbox. My own attorney has said, you need to go to a specialist. You need to go to a tax attorney. So this is something where professionals do refer, because professionals, we set aside our own ego, right? And we look at the client, we go, you know what? I can't do what this person needs me to do. They've got to get it from somebody else. And that's, that's just being, frankly, a mature professional where you realize your limitations. So not easy stuff. You need to assemble your A team. I don't know who you are in there, but you're kind of looking like Mr. T, Phil, today. I don't know. There's something about that. He's got that intensity. I don't know. But it is true. Rich people pay less because they do three things. All right. They hire the best advisors. They take their advice, and they have capital that they can deploy strategically. So what you've seen, many of these strategies require you to have capital. You have to have something. That's how you minimize taxes. So you can't, if a client comes in and they say, I'm making $10 million a year and I'm spending $11 million a year, it's really hard to do tax planning for that person. So who should do what and when? If you're a business owner, or you have more than, I would say, $2 million in net worth, including savings, investment, home, rentals, commercial, IRAs, and you want to pay less tax, I would encourage you to seek advice this year. If you want to pay less tax for tax year 2021, it does not start in February of 2022. And we're actually, Phil, are we getting kind of late in the game?
Yeah, well, I mean, it depends. For the business owners where they really don't know what their income is and it changes, a lot of times we do quarterly planning so we can give them their quarterly estimates. For people whose income is more level, or if the business is similar to last year, doing planning in the fourth quarter is fine. But you want to have plan. And when we insist on planning with our clients, because we want to have a roadmap. When we're doing that tax return, we want to know what the numbers are supposed to be. And if it deviates from that planning, we need to know why.
Yeah, and we have several clients, mutual clients, where we meet with them. I mean, some of them are meeting quarterly. I would say at a minimum annually. Most of them, we have 2 meetings a year. So at the sort of the beginning, sort of the end of the first quarter, and then beginning, kind of right around now. Shika asks, is the CRUT same as the RCLAT? That's two separate things. We didn't cover that here today. The RCLAT, which is a different strategy. We'll cover that on a different day. And so here's our website. This is how you contact us. You go to CunninghamLegal.com and you click a button to request an appointment. And we are happy to meet with you. We've got 10 lawyers in the firm, all kind of rowing in the same direction, focused on the same area of law. And here's Markham's website. They're open. That's great. So that's how you would contact Phil, is to go to Markham's website. And please subscribe to our YouTube page if you're watching this on YouTube. You can put your Q&A or comments in the comments section if you're not watching this live. But right now I'll open it up for questions. So we kind of got backed up on questions here a little bit. And let's see, resident commerce. Where may a business owner check to see if their business is in an employment opportunity zone? When I was researching this, I Googled employment opportunity zone map, and something came up. So Anita, I'm not quite sure how you would do that. Shika says, thank you. Amazing webinar as always. Thank you.
Thank you.
Andrew. So Andrew, I've got a little bit of your question here. It looks like you had a California transaction sale date, October 1, 2021, planning for 2021. Andrew, if this is a sale of real property, it sounds like you're teeing yourself up for a 1031 exchange, which we were talking about this earlier, sale of LLC. Ooh. If you already, is it too late, Phil, to do tax planning if you're selling shares of an LLC? I think it depends. That's going to be the answer.
Well, it depends on what you want to do, and it depends on the amount. I mean, the commercial solar could be a good opportunity there, depending upon how large the number is. Because there is a barrier to entry, because you need to have like I said, generally 3 to 5 million is the minimum of income. But definitely there's a lot of factors there. I would say email Jim, and then we could have a separate conversation about that. But it may not be too late, although we're getting very late in the year. The commercial solar projects, they're like real estate, so each one is unique. So if you say I need a $2 million project to help solve my tax need, it may not be available at that level. There may be one at 1.5 million or 7 million. So it just depends as we get later in the year. That's why we always encourage people to look at planning earlier in the year. But again, if you have a sale, a transaction, and you're selling your company, you're not going to want to do anything until the transaction closed, because as we know, deal's not done until a deal's done.
Andrew says large number. So if there's a lot of zeros on there, Andrew, just go to our website, request an appointment, or you can call us at 530-269-1515 is our main line. 530-269-1515. You can also reach us at 866-988-3956. But you can just go on our website. We even have a little chat feature where you can say, hey, I was on the webinar and I'm Andrew, and Jim said that we should connect. Kelly, Kelly says, does the charitable remainder trust have to be set up prior to receiving the income from the sale of a property? If not, how much time do you have to set up the trust? Yes, so this is really important. The charitable remainder trust, before you have a signed letter of intent, before you have listed the property for sale, you need to set this up. Okay, so this is one of those things that has to be done in advance. Not all of these strategies have to be done in advance. And Andrew says he'll follow up. Great, Andrew. Yeah, we've helped out a lot of people. We see a lot of clients, Phil, they'll sell their company for 10 million or 50 million or whatever it is. And then they look at the tax bill and it's shocking. They're like, I got to give half to the government. It literally, oftentimes it's half. So,
right. Especially in California.
Yeah. Especially for California.
Yeah.
And California has two issues, right? If you live in California, all your income is subject to California income tax. Even if you don't live in California, your California source income, that's subject to California income tax. So if you think, hey, I'll just move to Texas and keep collecting my California rent checks, or you're gonna have to pay California tax on that. So Anita says, clarify, can you donate a portion of an asset under a charitable remainder trust? Yeah, you can donate a portion. So in the example of the sale of the duplex, you could put a 50% interest in the duplex in the charitable trust. You could put a 70% interest, right? But what we were talking about, the split interest, is a charity must receive at a minimum, when you set it up, the charity must receive at least 10%. And that is what we call a charitable chassis. And it's a foundation for a lot of pretty cool planning strategies. And I will tell you, for those of you who are wealthy, who are blessed with wealth and blessed with means, if you're not giving back, and I'm not talking about taxes, because I don't view taxes as giving back. It's like giving up. All right. But if you're not giving back to your community and supporting the people and the causes and that are important, I personally feel like, we live in a republic, and if you're wealthy, you should be supporting charity. I support charity. Phil supports charity. If you're not doing that, I would say that's not a good thing. All right. So on that happy note, with no further questions, Phil, thank you very much. Thank you so much for joining us.
Thank you, Jim.
And that is your office. Is that the?
It actually is. Yeah, it is our office. It's a picture of our office.
Yeah. So beautiful offices, and you have offices in Costa Mesa, Los Angeles, San Jose, and San Francisco, and then about 30 others across the United States, right? Headquartered in New York City.
That's right.
All right.
That's correct, Jim.
All right. Well, thanks, Phil. Thanks for joining us.
Thank you very much.
All right.
All right.